Okay, if I could have your attention, welcome. And this is the Thursday program of a long list of programs we've had this week to celebrate the opening of the new edition. And we're delighted to have here today a panel of individuals that are not only experienced but bear the scars of the experience of the credit crisis that's gripping not just America but the world. And our panelists today are to the furthest left, George Krouse, who's an alumnus of this law school, is of counsel at Simpson, Thacher, and Bartlett. Between 2001 and 2006, he was the head administrative partner at the firm. He has worked in corporate law, but most importantly, for much of his career, and certainly a lot of his time recently, going up through this fall, was counsel for Lehman Brothers. As you're aware, Lehman Brothers, as we know it, is unfortunately in bankrupt. Most of us were aghast in 2002 when WorldCom filed for bankruptcy. It had assets of $109 billion, the largest bankruptcy of its time. The assets of Lehman Brothers were around $700 billion, so a scale of more than 6 times that of WorldCom. But what's important is just the cascading effect of the Lehman Brothers bankruptcy because of its prominence in capital markets, the number of credit derivatives and other instruments that were based upon the solvency and ongoing activities of Lehman Brothers are just staggering, and we're continuing to see the reverberations of the failure of Lehman Brothers. Next to George, and in the middle, is Nora Jordan, also a graduate of the law school. Nora heads up the, at Davis, Polk, and Wardwell, the investment management group. Her clients run the gambit of what we call buy-side individuals, or more likely entities. She's hedge funds, mutual funds, private equity funds, a wide host of entities, all of whom are scrambling because of the problems that exist in credit markets, going all the way from being backed up by collateral that has seen its value lost, mainly because of decline in home mortgage values and the cascading effect of that. And then closest to me is Ed Greene. Ed is a general counsel of Citigroup. He's general counsel of the Institutional Clients Group. Before that, he was a partner at Cleary Gottlieb, Steen and Hamilton. And as for those of you that have taken securities reg or will take securities regulation, you'll find that it was during his time at the SEC as head of the Division of Corporate Finance, as well later then general counsel of the SEC, that the process of integrated disclosure, shelf registrations came into being. So he's been both a public servant, private practice, and is an adjunct at a number of law schools. We're delighted to have them here. Now, just a little bit more about the credit crisis. I mean, as we know, this is not limited to America. When you look outside America, the foreign governments have taken actions to either provide funds or provide assurances, guarantees of funds in excess of $2 trillion to just their banking enterprises. We're approaching $1 trillion in this country, if we've not already exceeded it, the amount of money that's being put into the credit crisis to unlock the markets. This is a crisis that's unparalleled. Part of the crisis, as we know, is just the way that our capital markets have evolved, slowly initially in the 80s, picking up speed in the 90s, and then rapidly accelerating in the 2000s, and with the financial derivatives, which we were talking today that when we look at just one type of financial derivative, credit default swaps, that the notational value, the paper value of those, are somewhere in the range of $55 to $60 trillion. That's interesting about that is the GDP of America in 2007 was about $17 trillion. If you look at the total nominal value of derivatives, which are all interconnected, all interrelated with each other, all fed heavily by leverage, that the notational value is something like 17 times the GDP of the world. So there's a lot of interconnections here, and it's very difficult to quickly figure out the full dimensions of the problems, where those problems are coming from. We're sort of playing it by ear. So as a result of this, the regulatory landscape will be changing, is changing, will continue to change, and much of that's going to be driven about a vision of what the financial institutions will look like in the future. And so we decided that we will begin our part of the program by first having Ed Greene talk to us about his vision of the present and the future.
Thank you, Jim. It's a delight to be here. You remember the song, What a Difference a Year Makes? 14 months ago, the Dow Jones Industrial Average was at an all-time high. In the first half of 2007, investment banks had their highest revenues and earnings ever. And the key debate was how to maintain the competitive position of the U.S. financial markets in light of the growth of London, markets in Asia, and the Mideast. Did we need to tinker with our regulatory structure, not because it was broken, but perhaps to make it more efficient? And just about 12 months ago, which I learned the other day, the market capitalization of companies in emerging markets, China, India, Russia, exceeded the market capitalization of those in developed countries. And 6 of the top 10 companies in the world, in terms of market capitalization, were from these emerging markets. But now we're in a recession, perhaps some think bordering on a depression. The market capitalization of companies in emerging markets has fallen more than 60%, and the Dow Jones has collapsed. Investment in commercial banks have been weakened by losses equal to $500 billion to date. The key debate now is how we fix a regulatory system that is generally considered to be broken. How we should connect that system internationally and worry about efficiency would be considered broadly only after we fix it. And one has to keep in mind as we approach this issue that it was not hedge funds or private equity funds, who we always worried about because they weren't regulated, that caused or incurred the major portion of the huge losses that have resulted in the congressional bailout. It was some of the most highly regulated institutions in the world: banks, broker-dealers, and insurance companies. What contributed to the current debacle? First, I think, was excessive optimism, perhaps about the housing market. Second, leverage, as Jim mentioned. We had an explosion of participants in the market borrowing substantial sums to make investment. We had significant failure of internal risk models and of the government regulators' ability to appreciate the weaknesses in these risk models. Compensation incentives were not in line with shareholder interest, and there was perhaps an undue and unexamined reliance on rating agencies. Many of these products contributing to the losses were complex and often not understood by investors. Thus, they relied upon ratings. Who wouldn't when it was rated AAA? And those who were selling these products perhaps relied too much on disclosure and ratings and not enough on suitability of the product. As a result of this crisis in the financial markets, there is a strong congressional and state legislative distaste for financial institutions, and in particular, their management and board of directors. There is simply no sympathy in Congress today for the plight of financial institutions. And the new administration and the Congress is going to have several challenges. The first will be to sort out the asset purchase and insurance aspect of the recently enacted financial rescue plan. That plan is still in very broad strokes. We need to have it filled in by rules and other action. But more importantly, the second will be to identify what must be done with regard to our existing regulatory structure. And anyone who's looked at it has to be amazed at its complexity. First, we have 5 federal institutions that regulate deposit-taking institutions, and then we have states that regulate state banks. We have one federal securities regulator, the SEC, but each of the states also has the power to regulate securities activity, as well as self-regulatory organizations. We have one federal futures regulator, the CFTC, but insurance is regulated at the state level, not at the federal level. Now, my best guess is that the following areas will be considered by Congress, in part because some of them have already been the subject of hearings. Perhaps the most important is the call to establish a systemic risk or market stability regulator. The concept is to get as much information as possible for all key financial institutions, including hedge funds, including private equity funds, so that this entity can monitor and spot trends, which, if left unchecked, will lead to serious systemic problems in the economy. In a sense, what we need to do is unfragment data, put it together. And the key issue is to whether we need a new regulatory agency to achieve this, or whether we can do it through existing regulatory authorities, and what powers, if any, a new regulatory entity would have. The second is failure resolution mechanism. I can't underestimate enough the consequences of the Lehman bankruptcy were profound in terms of the capital markets. People simply did not appreciate the consequences of the largest bankruptcy in U.S. history. Multiple entities around the world with multiple exposures have to be sorted through, and it has really led to a reluctance of one financial institution to lead to another because of an uncertainty as to what happens if its counterparty may become insolvent. The bankruptcy laws are simply not designed to deal with broker-dealers who fail. We have to change that. Banks don't have that issue because banks are wound down by banking regulators. We have to restructure regulatory agencies in the financial services sector. We have too many. And we're going to have to combine the SEC and the CFTC because the difference between physical securities and futures is basically blurred. We need to have one entity with oversight of how capital markets work. Regulation of derivatives. This is going to become the bad boy of congressional regulation. These credit default swaps are fairly simple. They resemble insurance contracts. And they're contracts on bonds where you basically pay someone, and in turn, that person undertakes to reimburse you with respect to the notional amount if an obligation that's referenced goes bankrupt or otherwise has a credit incident. Well, the problem is that you don't have to own the underlying obligation to basically buy insurance. You may look at this and decide that you want to, in a sense, take credit insurance against General Motors because that's a fairly good surrogate for what might happen to the rest of your portfolio. As a consequence of not linking it to actual obligations, the market exploded into the trillions and trillions of dollars on a notional basis. So the question is, we have to regulate this. How do we do it? I don't think people know. But clearly, it's going to be highest on the agenda in Congress going forward. Accountability in the mortgage finance market. The aggressive use of securitization without accountability is seen as a major cause of the housing bust. We're likely to see originators licensed and putting requirements on banks that sell these securities to have some accountability. It will not simply be enough to basically originate the mortgage and sell it. One of the most contentious proposals might be to have banks have a vested interest in what they sell by retaining 5% of the interest, and the idea that their interest would then be aligned with the investors who buy it. We'll hear a bit more about hedge funds and private equity firms. In the past, they've escaped regulation, though there's been some calls. I think going forward, we've realized that they are key players in the market, and it's not tolerable to have them not subject to some form of reporting, perhaps some form of licensing. And there's a very interesting development that we hadn't focused on before that we're going to have to address. We've always assumed that money market funds were equivalent to bank deposits. People would come up to you and say, put your money into a 30-day money market fund. Those were thought to be as safe as bank deposits, but they were never insured. And what happened is the reserve fund broke the magic barrier of $1 because of the Lehman crisis, and it began to be clear that money market funds were not as safe as deposits, and that led to both a run on funds and another freezing up in the credit market. What happened? The Treasury had to step in on a temporary basis and insure money market funds so that they would basically give investors confidence. Well, that's going to create a conflict between, on the one hand, deposits, where the insurance has gone up to $250,000, versus money market funds, which are much, much larger. So at some point, there's conflict, and we're going to have to decide what's the best way forward, what is the role of insurance. And finally, there's going to be a focus on credit agencies. because the willingness to rate investment-grade complex mortgage products, they actually designed the securities so they could qualify the higher ratings, and they turned out not to have sufficient information, has led to a sense that they have been too laxly regulated and there must be accountability. And because of this public and government distaste for financial institutions, these institutions will no longer be able to rely on a strategy of simply opposing change as not being in the best interest of the market or undermining our competitive position. They will have to accept change because it's coming, and the question for all of us is how do we participate to make sure that that regulation is fair, efficient, and timely. And as we go forward, I would like to urge us to keep in mind some principles that we should apply as we decide how to modify our system. These are my views, not necessarily Citi views, but I've given some thought to it. First, all substantial-sized financial institutions should be subject to common baseline regulatory requirements and should have access to a standing Federal Reserve credit facility. That is to say, all institutions should have access to liquidity. Broker-dealers simply did not. That is why Morgan Stanley and Goldman Sachs are now banks. They needed access to liquidity. That is one of the most profound changes we've had in our markets in years. The industry should lead efforts to reduce counterparty and systemic risk, not the government. The current regulatory structure must be simplified to reduce overlapping or otherwise ambiguous jurisdiction. We must merge the SEC and the CFTC. But let's not forget that regulatory reform should also serve the goals of investor protection and capital formation, not just safety and soundness. And regulatory reform in the United States should take into account the increasingly global nature of the capital markets. Now, this is going to be very interesting because while markets are connected, as we've seen, markets are moving separately to address some of these issues. And rather than focusing on a common approach, we may run the risk of markets adopting solutions applied extraterritorially and therefore inconsistent. Take rating agencies. We are going to regulate rating agencies. The European Union is going to regulate rating agencies. It's going to be a different regulatory approach. Both will apply globally. So what happens if one system says investors pay for rating agents' fees and the others say that issuer does? Which one will prevail? How will you decide? It's these issues that I'm worried about, that as we focus on fixing internal markets, we must keep in mind that these markets are linked. And I would hope that as a result of the initiative that President Bush has started and that President Obama will, I hope, continue, try to link together to have common approaches rather than each market trying to do it on its own. And with that, I turn it over to you.
Thanks, Ed. Well, now we'll hear from somebody who's spent her professional career and continues to, representing people who, up to this point, followed and made money by buying low and selling high. I guess there's a lot of buying low possibly today. I'm not sure about the selling high, but Nora?
Sure. I'm actually going to focus my comments today on my much-aligned clients' hedge funds. And I was glad to hear Ed say that hedge funds did not cause the financial crisis. There are others who say they did, and I'm here to defend them. Ed went on to say, though, that he thought hedge funds would be regulated, and he's probably right about that. And they're going to be regulated because there has been so much, I think, misinformation about hedge funds, partly because they are not transparent entities. To make sure we're all on the same page, let me just talk about what a hedge fund is, because I think there is some misunderstanding about what hedge funds are. Hedge funds are a pool of money from a bunch of people that's put together for investment. So you have companies, you have individuals, you have pension plans, you have the Duke Endowment Fund. They all put their money together and they hire a manager, a hedge fund manager, to manage that money. The manager generally gets about 2% of assets under management as a fee, and he gets 20% of the profits that are made off that fund. That's generally, it's all contractually negotiated. Now, funds have gotten huge in many ways. In terms of dollar amount, there are many, many funds that are in the billions. Just Davis Polk, for example, we used to not take a hedge fund client unless they had about 100 million. Almost all of our clients now have over $1 billion. So the first problem that I will talk about is when you look at 20% of profits and a 2% fee on a fund that's $1 billion, it's a lot of money. So there has been a lot of complaint about the amount of money that hedge fund managers are making. But is that illegal? That's our system. It's capitalism. It's different than the question of executive compensation, although it's gotten lumped in with that. Executive compensation is a whole different issue. It's, a board of directors that has a duty to shareholders to negotiate on their behalf and to pay employees that are on the public payroll, really, not the public in terms of, everyone, but they're public shareholders. The hedge funds are really negotiating with their investors. But it's important to remember that this compensation issue, individuals making hundreds of million dollars, is lurking in the backs of the minds of many regulators. We then move to the fact that hedge funds are not regulated. Unlike mutual funds, broker-dealers, banks, there's a body of regulation that applies to them. Hedge funds are exempt from regulation because of a provision in the Investment Company Act of 1940 that says if you have sophisticated investors or less than 100 investors, you don't have to be regulated. So we've got this big pool of assets with no regulation. The advisor to the hedge fund, the Chilton or Lone Pine or Renaissance, sometimes is regulated as an advisor, but sometimes is not. And that's because of an interpretation the SEC took some time ago. They tried to change their mind about 2 years ago and say, we're going to regulate these guys. They got taken to court by a hedge fund manager who works out of his basement in Westchester, New York. And that guy won in the DC Court of Appeals, and so many advisors are not regulated. So now we have these huge pools of money, billions of dollars, that are not regulated. And, the Treasury and the government start thinking about this way before the crisis and thinking, maybe we should regulate these guys. They come out with this report called The Blueprint, and they talk about regulation of banks and broker-dealers. And buried in there is a little reference to, we should probably look at these hedge funds again. So when people asked us about what's going to happen with hedge funds before the crisis, we said, oh, they're probably going to get regulated. There'll be something, but it'll take them years. Then the financial crisis hits, and Bear Stearns almost goes down. And everyone's saying, how did this happen? Who caused it? Where did we go wrong? And everyone can talk about Bear Stearns having a bad balance sheet and distressed assets, but there was a lot of looking at hedge funds because the biggest clients of all the broker-dealers out there, or the major broker-dealers, are hedge funds. About 50% of the trading of the big broker-dealers is with hedge funds. So Bear Stearns starts having a little trouble. Their counterparties, the hedge funds, say, well, wait a minute, I don't want to get sucked into a Bear Stearns bankruptcy. This is going to be bad. So they start pulling business away from Bear Stearns to protect themselves. In addition, the Bear Stearns stock starts going down for a lot of reasons. They have things on their balance sheet. But in addition, there's a lot of short selling going on. Who are the short sellers? Hedge funds short sell. So now you've got the hedge funds pulling away their business from Bear Stearns, and you've got them short selling Bear Stearns stock. The more the stock goes down, the more the hedge funds are pulling out their money. And so is everybody else. I mean, hedge funds are really an institutional investor in this company. And just like everybody else, they started pulling out. But people started making a lot of noise that the hedge funds were causing the financial crisis. And so a lot of attention started being put on them. Next thing that happens, Lehman. Same thing. Counterparties are all hedge funds. Hedge funds are starting getting worried. They start pulling their business away. Short selling is going on in Lehman stock. Dick Fuld, head of Lehman, starts complaining. I think it's interesting to note, though, that he himself did not blame it all on hedge funds. He also cited Goldman Sachs as being a big shorter of Lehman stock. There are now investigations over all the short selling, and short selling is legal. But was there collusion? Was there manipulation of the market? Were people spreading rumors to make the stock go down so that their short sale would be profitable? All of those are still being investigated, and so far there hasn't been any evidence that hedge funds have actually done this, but lots of investigations, and likely somebody did this, whether it's a hedge fund or somebody else. It doesn't mean the whole industry is tainted. So then what happens? We're in the middle of the crisis. 2 financial institutions and many more are now in distress. The SEC says, no more short selling. We've got to stop it. A lot of people think short selling is very important to the market to make sure that prices don't keep going up. But within a course of about 2 weeks, they come out with 5 different short sale rules. They're banning short selling. Short selling is now allowed again. There's going to be public reporting of short selling. There's going to be limits on short selling. And to be fair to the SEC, I mean, this was a huge crisis with very little time to come out with rules. They did the best they could, but these short sell rules had a significant effect on hedge funds. I mean, They had a lot of sales. All of a sudden, short selling has stopped. It affects their price. So that was kind of the first regulation that was really aimed at hedge funds. And in fact, the SEC, when they came out with their first release, said there will be a hearing tomorrow on how can we stop hedge funds from short selling. Our legal system does not work where you say X cannot do Y, X cannot do something, but Y can. That's not the way it works. You don't take a whole class of people and say they can't short sell and other people can. But a lot of the talk was going along those lines. When the rules eventually came out, they did make it clear that it applied to everybody, not just hedge funds, but it was quite clear that all these rules were aimed at them. So what's going to happen going forward? Don't know, but I can tell you hedge funds are going to have some regulation. It's possible that the advisors will be regulated. It'll take probably some congressional action. It's possible that they would take the hedge funds themselves, the pools of security, and try to put limits on how much leverage they can have. The TARP legislation so far, the government has made it very clear that they're going to help a lot of institutions, but they're not going to help hedge funds. And the way they do that is they don't say specifically hedge funds will be helped. They say institutions that are not regulated. And they define a term in such a way that it's clearly that's what they're heading at. So what else is happening? That's kind of the legal front on the hedge funds. On the business side, actually hedge funds have had an extremely tough year. They were the buyers, they were the holders of all of these companies that have done so poorly in the market. It's estimated that the average hedge fund is down 20 to 25% for this year. This is not good. It's not good for the investors, and obviously the investors are going to want to get their money out. So hedge funds have limited liquidity. They let people out some quarterly, some annually. A lot of hedge funds let investors out at the end of this year, and a lot of them have 30 to 45-day notice periods. So November 15th is a big day for hedge funds. That's when they're going to find out how many of their investors want to get out of their fund. And the problem is, as you have heard, there is no liquidity in the market. So how is a hedge fund going to give out the money to all of its investors when they can't liquidate their portfolio? So the hedge funds are starting to sell now. That's obviously having an effect on the market price of some of these securities. And after November 15th, they're going to be selling a lot more. And there's, again, this cascading or domino effect because the Duke Endowment, for example, has to pay out a certain amount of its money every year. So they need to get out of some of their investments. So they need to go to a hedge fund or some other investment and liquidate it. So that causes the hedge fund to have to liquidate. The fund might be invested in another fund. And there's this whole chain reaction of people trying to get cash and they can't get it. So I think the end of this year is going to be pretty tough. And part of it is because of the liquidity and the hedge funds trying to sell. Does it mean the hedge fund industry is going away? I mean, I think there are going to be a lot of hedge funds that disappear by the end of this year. They're going to go into liquidation, particularly the small ones. And there'll be others that'll take 2 years probably for them to run off. There'll be hedge funds that downsize. But to me, this is more like what happens in any industry that has a huge growth spurt. You know, the market forces are going to take over. People are going to look at these hedge funds. The strong will survive. The good ones will survive. There'll be a rejiggering of the fees, likely. A lot of our clients are thinking maybe we need to lower some of these management fees. There'll be incentives for people to stay in. People don't like the fact that, you know, investors can get out on a quarterly basis and they're forced to sell in illiquid markets. So I think market forces are probably going to take over, and probably there'll be a lot of kind of self-regulation of hedge funds. But we are not so naive as to think that the federal government won't do anything either. It's just a question of what they do.
I forget what the statistic is, but the management company that runs the Duke University Endowment also runs the family endowment, the Duke Endowment. But I think something approaching 60+% of the portfolio is invested in hedge funds that are in various forms of securities. And another part that's invested in other things, which are oil and property, oil and gas, and real estate, et cetera. So we are all linked to this in some respect or another. I remember talking to George Krouse last spring. He's looking forward to stepping off the frantic pace of his life at Simpson, Thacher, becoming of counsel, and your life has become more frantic because of the unwinding of the markets. But George is going to talk to us from his perspective of being very deeply involved with this, representing a player in the marketplace.
Thanks, Jim. By way of full disclosure, I've spent most of the 38 years since my graduation from law school here as a securities lawyer with Simpson, Thacher, and Bartlett. And I had the good fortune for most of that time to be engaged in various capacities, and for the last almost 20 years as the principal outside counsel at our firm for Lehman Brothers, which has historically been Simpson Thacher's principal investment banking relationship. And as we get into this, I'd just like to preface my remarks with a statement that former Fed Chairman Alan Greenspan made on October 23rd at hearings before Congress. Those of you who may be watching these things on CNN and elsewhere and C-SPAN, he and Chairman Christopher Cox of the SEC and former Treasury Secretary Snow were requested to testify before Henry Waxman's committee. And at that particular session, Alan Greenspan, who has some experience in these matters and who served as 18 years as chairman of the Federal Reserve, testified that we are, quote, in the midst of a once-in-a-century credit tsunami. And I think it's important to keep that in mind because hindsight in these types of situations is better than 20/20, and second-guessing goes on all the time. And I think as we look what has happened in the credit markets and in the financial system on a greater and broader basis, I think when we start allocating responsibility or blame, I think it's important to keep in mind that even Alan Greenspan and those at the Fed and other major U.S. regulatory agencies were quite taken by surprise with what happened in an environment where we now, as opposed to at the beginning of this year when we had 5 major pure standalone investment banks, today we have none. Lehman Brothers is gone. Bear Stearns is, for all intents and purposes, gone. It's part of J.P. Morgan Chase now. Merrill Lynch was rushed into a shotgun marriage with Bank of America one weekend. And Morgan Stanley and Goldman Sachs, which were the perhaps 2 preeminent U.S. or global investment banks, are now, as Ed Greene mentioned, are basically bank holding companies regulated by the Federal Reserve. So how did we get to this point? Well, for me, it's been a very personal journey for the past couple of months because Lehman Brothers was forced to declare bankruptcy on September 15th as a result of what I think can only be characterized as an unprecedented, extraordinary run on the bank. In the end, despite all its efforts, Lehman was overwhelmed, and still other institutions would have been similarly overwhelmed had the government not stepped in to save them. And why Lehman was chosen to fail and others were not is a story for another time. What happened to Lehman certainly could have happened to any institution on the street and nearly did happen to others. Within a week after Lehman's bankruptcy, Morgan Stanley's stock plummeted by more than 40%, and Goldman Sachs was down about a third. The fallout from a litany of destabilizing factors, rumors, concerns about portfolio risk, balance sheet leverage, widening credit default swap spreads, naked short attacks, credit agency downgrades, a loss of confidence by clients, lenders, and counterparties, and strategic buyers who remain sitting on the sidelines looking for an assisted deal were an all too familiar tale for these institutions. And the fallout from these repeated onslaughts finally compelled the government to dramatically change the rules of the game. As you know, the Federal Reserve is basically the lender of last resort for bank holding companies, for federally chartered banks. And they made their credit available to investment banks and brokerage firms at the end of the crisis. It's going to take a long time before all the factors that led to these seismic events are going to be determined and sorted out. And obviously many books will be written on the subject, but I'd like to address a few of these developments that led to fundamental changes we've experienced in the investment banking industry and suggest what we might expect going forward. First, what ultimately happened to Lehman and was happening to a number of the other financial institutions was the direct result of a lack of confidence. And those of you who have studied history and the Great Depression, I think understand that inherent in the events of those years were basically a sense of national and economic panic. And certainly this is what we were dealing with here, that morphed quickly into a sense of overall distrust as to what was going on in the entire investment banking field and financial institutions generally. As evidenced by Congress's enactment of the Troubled Assets Relief Program, there was systemic lack of confidence that without emergency intervention would have resulted in an across-the-board failure, potentially, of the entire financial system. While all investment banks are prepared and were prepared for some degree of foreseeable shocks to the market, I think, as Chairman Greenspan indicated, none could be prepared for this. Investment banks depend more so than almost any other financial institution because of the huge balance sheets exposure they would maintain. Investment banks depend on the confidence and trust on an ongoing basis of clients, investors, lenders, and counterparties. And unlike commercial banks, first, investment banks had been subject to mark-to-market accounting, which is currently being reviewed by the SEC, which resulted in them having to mark their positions to the weakest competitor's fire sale of assets during this period. Number two, they could not access deposits for funding purposes. Morgan Stanley and Goldman Sachs, now being commercial banks, will have that ability. And until too late, they lacked a lender of last resort, basically the Fed. These problems were further exacerbated by a second factor that Nora alluded to, and this was unprecedented, not just short selling, but naked short selling. Naked short selling is the practice of selling shares without first owning, borrowing, or arranging to borrow those shares, in essence, selling something you don't have and may not ultimately get. While short selling by itself can be employed, as Nora indicated, as a legitimate hedging device against risk, naked short selling can truly be a vehicle for market manipulation. And it was not only Dick Fuld of Lehman, but a number of others in the industry who were calling out and concerned about the short selling that was taking place at the time. In fact, the SEC and foreign regulators, perhaps a bit belatedly, recognized this potential for manipulation. In fact, it was over the summer, I think in July, that the SEC enacted a temporary ban on naked short selling and then reinstated it, and that's when the trouble and the cascading of troubles began once again. So the question is, what can we expect for the investment banking industry going forward? First, it seems that investment banking, as we've known it, I'd say over the past 20 years, is unlikely to return for some period of time, at least in the structure that it existed in. I remember, and I'm sure Ed will remember, that 20 or 25 years ago, concerns were developing about the configuration of the investment banking business at that time, because increasingly commercial banks with their deposit base were getting into areas of business that had traditionally been the realm of investment banks, and yet investment banks lacked the balance sheets that commercial banks did. A way that investment banks dealt with this at that time was a number of them sequentially over a period of years, beginning early on with Merrill Lynch and then ultimately through Goldman Sachs, became public companies in order to access basically equity through the capital markets. As recently stated, however, in an article in the Wall Street Journal, going forward with the only two historical investment banks remaining of any size, Morgan Stanley and Goldman Sachs, looking at the prospects for these institutions going forward, it's going to be a much different environment for them because they're going to be subject to a whole different scheme of regulation. And it's hard to see a place for some of these firms who have huge balance sheets. I think at the end of August, the combined balance sheets of Morgan Stanley and Goldman Sachs was something like $2 trillion. It's hard to see how companies will be able to maintain, under the regulatory scheme that's likely to evolve, balance sheets of that size and certainly have a predominantly capital markets focus. That's thing one. The second thing that I think is going to happen is that the umbrella of regulation is going to be expanded, and as Ed alluded to, there are obviously areas that this can be done in a very beneficial manner. The idea of combining the CFTC and the SEC has been something that's been discussed a long time. The thought of combining the control of the currency and the Office of Thrift Supervision. Areas of oversight and regulation agencies that have similar and almost adjacent, but not necessarily overlapping areas of responsibility. So I think what we can expect is a fairly wholesale revamping of the U.S. regulatory system. At those congressional hearings that I mentioned on October 23rd, each of Greenspan, Chris Cox, and former Treasury Secretary Snow criticized what they viewed as the existing stovepipe or balkanized aspect of regulation of financial institutions in the United States. And all of them called for a greater, more umbrella approach to oversight, including merging some agencies and perhaps re-examining the whole universal regulation approach with a single regulator that would have oversight over the entire financial services industry. Comparison, other countries, European countries, the UK, have a much more single regulator approach to the way they approach their financial markets, and I think you're going to see some migration to that. It makes a lot of sense. I mean, it's hard to imagine in some ways that we've been able to last as long as we have with the regulatory system that we have in place. The current regulatory system was put in place in the early 1930s. Back then, the New York Stock Exchange traded about 10 million shares a day. Today, that figure is over 5 billion shares a day, not to mention the evolution that's taken place in the technology of the products that are traded on a daily basis, the markets that they are traded in, and the global interconnection of the financial system that we're faced with. So I think going forward, over the next 6 to 9 months, there's going to be a lot of things going on in Congress and at the state level. Insurance companies, as you probably know, are regulated primarily at the state level. But there's going to be a lot of effort applied to try to expand the umbrella of regulation and make sure that the gaps that currently exist, frankly, in some of these areas of regulation are filled in to avoid things like this happening in the future. And I think what Ed alluded to in terms of a systemic risk regulator is certainly something that one can almost count on. How that's going to be put together and the types of responsibilities and powers that particular agency is going to have, well, as they say, the devil is in the details, so we'll have to see how that comes out. But one thing we can be sure of is that things are going to change. Now, for the investment banking industry, I think what you're going to see is a reversion to some degree to the landscape in terms of structure of investment banks that we knew 20 or 25 years ago. Obviously, the Morgan Stanleys and the Goldman Sachs in their new configuration will continue under obviously a more regulated environment for them. But currently there's a lot of unemployed, high-quality talent on Wall Street that's come out of these firms either that no longer exist or have gotten merged out of existence. And I think these people tend to be basically ambitious, less risk sensitive than some other areas of the financial institutions businesses. And I think that you're going to see other smaller boutique firms start up again, more in the model of, say, a Lazard. And frankly, there are existing private equity funds now, private equity shops like Blackstone, which over the past 4 or 5 years have increasingly gotten into more and more of the traditional investment banking business that had been provided for by the more full-service investment banking firms like merger and acquisition advisory work and that sort of thing. So I think you're going to see a bifurcation. I think there's going to be a return to, for a time being anyway, to smaller firms, more boutique-oriented firms, largely configured as partnerships, and not public companies. And I think that will have a benefit to some extent because it will basically allow these firms not to manage on a quarter-to-quarter basis to show, to basically respond or be responsive to market expectations with respect to stock price and that sort of thing. But I also think it will make them a little bit more cognizant of risk because partnerships, as you know, are different from corporations in terms of how the principals share the risk. And I suspect that's going to be more of what we're going to see in terms of the smaller firms going forward. So that's it. Thank you, Nora.
Well, I think I'd like to ask each of our panelists to reflect on the following. You get that phone call at 2 o'clock in the morning. Heard that before. And it's President-elect Obama. And asks you to put an item on the wish list for regulation going forward, regulatory change. You know, as you reflect on this and think about where you'd like to see a change occur. I mean, Ed, you talked about having a simplification of regulation, so we have to take that off and think about something different in your case, and that one's already out there. What would you add to the wish list going forward for things to help us get out of the credit crisis, or to make sure that once we start making progress on getting out of the credit crisis, that it doesn't raise its ugly head yet again? So if I could direct that to Ed first and just go in the order in which we...
Well, what's interesting is that the system has gone into the institutions themselves, but with no requirement as how the institutions spend that money. And there's some perception that lending hasn't increased, that the credit markets are so thawed. I think we have to now follow some of the steps that, for example, J.P. Morgan has reached out and deal with people who are suffering through this in terms of mortgage defaults. If you think of it, we've invested $125 billion in the 9 largest banks, but they're fairly free to do with that money what they want. In Europe, there has been some limitations at what it can be done with it, but there hasn't been guidelines laid out as to how that money gets out into the economy, how it basically frees up the credit market. How does it help people who have defaulted mortgages? And that's where I think the next step is. We've looked at the regulatory system. Now we've got to reach out to the consumers who are affected and be sure that aid going in does get into the markets in ways that make the market more responsive.
And let me to amplify something there. As we all aware, the Secretary of the Treasury called the major banks in and told them that they were all going to sign an agreement and they were all going to get a certain sum of money, okay? And so your client was there, Ed, and others' clients were there. And they had no choice. It wasn't a question they were asking for this money, they were required to take the money. One of those who took the money was J.P. Morgan, signed the agreement and took the money. And it was just a few days ago, there was a widely publicized conference with analysts and others, because you have to do these things in a public forum, not being aware that there was a columnist from Bloomberg that was on the wire, and which J.P. Morgan said, for pretty much what you're saying, Ed, and I'm saying this in somewhat in defense of J.P. Morgan, that we don't plan to be using the $12.5 billion or whatever the sum of money was to be for lending. We're probably going to use it for acquisitions, okay? So that's the issue. The issue is that at the get-go, the government didn't lay in these requirements, okay? And this is not a question that the money always went to everybody who wanted it. The reason Polson said everybody had to take the money is because you didn't want to have some people saying, I want the money because I need the money, some people saying, I don't want the money because I don't need the money, because then that sends a signal to the marketplace that you have weak banks and strong banks, and there's a run on the weak banks, okay? So that's a pickle we sort of got ourselves into, but later. Nora, what's on your wish list for that 2 o'clock in the morning phone call?
Well, I'll have a short career if I start recommending regulations for my clients. So instead, maybe I'll talk about what I would say about another solution for the financial crisis. I think the 2 biggest problems that we still have are transparency and liquidity. There are a lot of banks who still own a lot of securities that are these distressed securities, and no one knows what they're worth. And I think everyone's afraid of the dark, and so there's a lot of fear out there because people don't know what the prices are. And then the securities can't be sold, there's no liquidity. I think, you know, the things that have been done so far have been to restore kind of the balance sheet of these companies, but they haven't done anything to actually get those securities moving, to get people buying and selling the securities. And without getting too technical, I think there is one thing they could do, which is the TARP legislation allows the Treasury to use insurance, and it doesn't say how they can use it. And one of the ways they could use it is to say, if J.P. Morgan owns a security and they find a buyer for it at $10, that the federal government would guarantee that the buyer would get some percentage of that, say 80%, 85%, 90%. And that way, the buyer is willing to buy because he's only going to lose 10 or 15%, whatever the number is. So he's willing to buy, and the seller can get it off its balance sheet. And at the end of the transaction, we actually know what the price of the securities is. When the government is buying securities, everyone says, who knows what that means? They're just buying it to save the company. And so we need buyers and sellers, and I think they should try to come up with some solutions that get securities moving.
And on this question of transparency, I thought it was very telling that I had gone back and looked what the recent updated published information was on Wachovia Bank about what its book value was, assets less liabilities, just on the eve of the announcement that it was in play by first Citibank and then ultimately acquired by Wells Fargo. And the book value, if I recall, was something like $70 billion. And the purchase price by a knowledgeable bank dealing face-to-face and stuff like that was about 1/3 that, which is an indication that nobody knows what the hell these values mean because the banks are not eager to market, partly because we don't know what market is in that transaction, but also not eager generally to report a bad number. George, what's on your wish list?
No, I don't want to sort of repeat what Nora has said, but I think transparency, to me, is the primary issue. Understanding that human ingenuity is almost infinite, and that nothing we can do based on what we know today, and what we have now is imperfect information in terms of what actually happened and what the actual condition of some of these obligations are. But I think we do know now that one of the important demons in this, what brought us to where we are now, is this use of credit default swaps. And I think most people, probably most people in this room, couldn't define a credit default swap. And I think most people don't even understand what they are, including, I'm afraid, a lot of people actually creating them and trading them. And it's pretty frightening when, as you said earlier, the value of some of this exceeds the world's gross output, economic output. And so clearly this was had the potential for cascading. And it would seem to me that while it's hard to get our hands around the financial system to such a degree that we can anticipate everything that's going to happen in the future, I think this is an important lesson to have learned and some way to bring this within this particular type of product so that more of the institutions we're dealing with know exactly what it is they're dealing with and the multiplier effect that these things carry with them. And so that they can better understand their own position and their obligations is an important first step. At the hearings that I mentioned earlier on October 23rd, each of Greenspan, Cox, and Snow indicated that a real culprit in what has happened was the tremendous emergence since late 2004 and 2005 of credit default swaps, which are basically, if you look at it in its purest sense, is almost a form of casino gambling, because you don't have to have any skin in the game, you don't have to own the underlying obligation, and yet you can be responsible for untold amounts of liability and exposure if things move the wrong way on you. So I think having some sort of system that tries to regulate and control and have a single place where this stuff is traded and understood would be a good first step.
We would be eager to entertain questions, whether at 2 o'clock in the morning or otherwise, but right now, there are panelists prompted from you. So if you have any questions, please hold up your hand and I'll try to hear them. And okay, if you can speak. So the idea is, in part, is that the question is as regulation squeezes in on one area, it pops out another area, much like a balloon. Am I correct? That if you have regulation in one sector, that bankers being creative will go to some other area to avoid where there's less regulation?
I think that's an interesting question because there has been some very interesting analogies to after World War II and the meeting at Bretton Woods. And in Bretton Woods, three things happened. Currency rates were stabilized, the World Bank was created, and the IMF. And the IMF, in a sense, lends globally. And the idea is that to give more power such that the 30 largest financial institutions globally would be subject to global regulation, on the theory that that would, first, markets are interlinked, secondly, regulators have to cooperate, third, there is a sense that there is limitations in how various countries can deal with the growing problem. I think that will be on the agenda of the G20 meeting that Bush has called after the election. The problem is, people have been very reluctant to cede national oversight to major financial institutions and rely upon regulators in other markets. And that's something that may be impossible to overcome. But it clearly will be on the agenda because the recognition is that the largest banks in the world, for two things. One, we are a universal bank model. That's the model going forward, not investment banking. Universal banks will raise deposits around the world, do business around the world. How do we force regulators to interact to be sure that we have consistent and effective oversight? And that is going to be a challenge, and one of the issues on the table would be to try to have the top 30 regulated by something like the IMF with the expanded powers.
Lynn?
The discussion thus far has been very antiseptic. These things happen, we have regulations, we don't have regulations, and waves sort of cascaded over Wall Street. I wonder if we could plug in the human factor here and have people comment on whether this really is substantially affected by greed, dishonesty, lack of ethics, or unfortunate incentives for people making very large amounts of money at hedge funds or investment banking firms. This did start, if I understand it, with mortgage bankers placing loans with people who couldn't afford to pay them, and turning them into securities with complicated tranches who were bought and sold by people who didn't understand them, and rated by people who didn't rate them properly. And I understand that then it gets very complicated with default, swaps, whatever they are. But at the core, don't you have a lot of very creative people doing things that they ought not to have done in their businesses? And I particularly think the rating agencies entirely missed the ball and let this thing go past them.
Yeah, I mean, I think there's no question that the human factor was huge here. And whether it's greed or sloppiness or survival, I think there's no question that the incentives are very much to make money. Not only on Wall Street, but brokers, people who are lending money in California. I mean, people who weren't even making that much money, but they had the authority to give the loan or not. And to try to change the incentives is going to be difficult. Lori Richards, who's the head of compliance at the SEC, actually wrote a piece, I think she gave a speech, and I read it just a couple days ago, about is there a way to provide incentives for people to be compliant and honest? And I don't know. She doesn't come up with an answer. We're in a capitalist country, and everybody's trying to make money, and I think institutions have to take greater responsibility to oversee people and what they're doing. But I don't think it's just on Wall Street either. I think it's all over the country. The people cut corners trying to make a buck, whether it's $100 million or $10,000. I mean, it's a valid point. I mean, people were at the root of this.
Well, I hope you join me in thanking our three panelists for taking time out of busy professional and personal lives. Not only for our gratitude for them doing that today and sharing their insights with us, but for each of them having grappled with the very real problem that's touching all of us. Thank you very much.